Wall Street is sending a strong message about the future of the stock market. And that message is optimism after the Federal Reserve's recent interest rate cut. Major U.S. indexes, like the S&P 500 and the Dow Jones Industrial Average, reached record highs for investors. This signals renewed confidence in economic growth moving toward 2026. One of the biggest drivers behind this optimism is the Federal Reserve's stance on monetary policy. During his latest press conference, Fed Chair Jerome Powell delivered remarks that analysts described as less aggressive than expected. Why does this matter? Because lower interest rates make it cheaper for businesses to borrow money, expand operations, and invest in growth. They also make stocks more attractive compared to bonds and savings accounts. The Fed also raised its economic growth forecast for 2026 to 2.3%. Stronger economic growth typically means higher corporate revenues, rising profits, and better earnings, all of which support higher stock prices. As a result, major Wall Street firms are increasing their forecasts for the S&P 500. Veteran market strategist Ed Yardeni believes the index could reach 7,700 in 2026. He points to government stimulus, tax benefits, and the continued expansion of artificial intelligence as major growth engines. Oppenheimer is even more bullish, setting a 2026 target of 8,100 for the S&P 500. The firm believes that easier monetary policy and supportive fiscal conditions will benefit both companies and consumers, leading to stronger earnings across the market. UBS shares a similar outlook, projecting the index could reach 7,700 by the end of 2026. Their confidence is based on resilient economic growth, continued interest rate cuts, and a surge in AI-related investment spending. Goldman Sachs expects corporate earnings to grow by more than 12% in 2026. Importantly, analysts believe this growth will not be limited to just a few megacap technology stocks. Instead, they expect gains to spread across a wider range of companies, creating a healthier and more balanced market rally. Deutsche Bank has also joined the bullish camp, forecasting the S&P 500 could reach 8,000 by the end of 2026. Other major banks, including JP Morgan, HSBC, and Morgan Stanley, see strong upside potential, especially if the Federal Reserve continues cutting rates. So what does this mean for everyday investors? It suggests that Wall Street expects supportive policies, strong earnings growth, and technological innovation, especially in artificial intelligence, to drive markets higher over the next few years. While no forecast is guaranteed, understanding these trends can help investors make more informed decisions and stay focused on long-term opportunities rather than short-term noise. This content is for educational purposes only and does not constitute financial advice.